And good afternoon, ladies and gentlemen. Thank you so much for braving the rains and weather. I think the afternoon has been a little better than how the morning was. But still, thank you so much for taking the time out and coming here, joining us. I would like to welcome all of my panelists. Uh, I wouldn't invest a lot of time in introductions or long introductions, but as you can see, I have a very, very esteemed panel. A lot of experience amongst these four, I think 4 times my age. I'm not that old. Uh, but a lot of experience here, and I would love to dive into this overarching theme, which is changing role of CFOs, right? From financials custodians or gatekeepers to strategists in the current day and age. Uh, so just to set the context, everyone, you know, these days, just apart from being financial custodian or finance controller, there are a lot of roles and responsibilities that CFOs manage, a lot of tools and technologies they are using. In fact, a whopping 73% of the CFOs said in a recent study that they are using technologies such as AI and other platforms to deliver on the responsibilities of their function, and they're taking over a lot of responsibilities with respect to ESG, sustainability, and other issues. They are the flag bearers in their respective organizations. So, having said this today, and what the scenario was 30 years ago, wherein many organizations just had one designation, which was chief accountant. So, CFO was not even a designation at a lot many organizations. Over the years, the CFO's role has changed. We have a esteemed panel. I would like to, come to you, Pinky, with my first question. How are the traditional CFO skills, which are still very, very important and pertinent, and the modern responsibilities evolving in today's dynamic business environment?
Thank you. So the thing is that no longer the CFO is now a custodian or a gatekeeper of the finance or a capital. To be very frank, the the thing is that now each and every company is not even affected just by the microeconomics, but the macro plays also a very important role. Like a geopolitical tensions, the global recessions or a COVID pandemic, everything is affected. The thing is that apart from being a custodian needs to play a very important role. It needs to drive, the digital transformations, the ESG, sustainability, anything, the risk. The risk is not only of the, wherever it affects the bottom line, it needs to look into the each and every risk, the operational risk, the marketing risk, the currency risk. Everything needs to be, the CFO needs to drive and to be a part of each and every discussions, even the strategy, mergers, acquisitions. It needs to play a very important role and work with the cross-functional teams and work closely with the CEOs, to drive it, because we wanted to make the business the resilience. We need to be a co-creator of the enterprise value, and we need to be a proactive and to take the informed decisions. So it's a responsibility of the CFO to create such an environment, where with the management taken informed decisions. To be very frank.
Would you like to share any? Like to sh- Would you like to share any specific example from your past experience?
See, let me tell you that from my career started with the manufacturing to, that I was a CFO of the Aditya Birla No Limited, where we had a many manufacturing, which I had a viscose filament yarn, I had fertilizers, I had carbon black, which was an unregulated entity, and from 2017, I become a CFO of the Aditya Birla Capital, which is, the holding company of the financial service business of the Aditya Birla Group. And all the companies are regulated in the sense that we are regulated by RBI. I have a life insurance, the health insurance, which is regulated by RDA. The expectations even of the investors, the stakeholders, the regulator is that they look only upon the CFOs, when it comes to, any of the compliance, whether it is, the dealing with the investors, the governance and everything. So I think the CFO has to play the role, has got a sweeping change. Earlier, it was on the bookkeeping and all because we did not have too much of the digitizations. I started my journey, typing my trial balance and the balance sheets with the typewriting. The minor mistakes used to be there. We used to correct. I still remember with the writing, you know. And then if the major mistakes comes and all these things, you used to retype, with a typewriter. The days have gone, Now the much of the time goes, making up the financial modeling, various scenario building, analyzing the data, and the main thing is that you need to have a real-time data,
Okay.
which enables the management to take a informed and a timely decisions, and much ahead of the curve.
Thank you. Thank you so much. And if I could come to you, Mayur, with the same question on the changing role and the traditional CFO skills vis-a-vis the modern responsibilities.
Yeah, thank you. Sure, I think I think what we have been hearing about our role. I think most of us are the finance people in this forum. Of course, others also welcome. But I think we can look at the CFO role into let's split into some time zones, right? So if we think about prior to 2000, right, we were what we were. We that was like always bookkeeping, statutory reporting, and managing tax, hiding tax, hiding profits. Sometimes was also one of the objectives those days, and also the objective was reporting, auditing, doing the basic accounting work, which was done till 2000. And then we talk about next 15 years, for example, then most of the finance function was busy in creating accounting systems. Like we evolved into computerization phase where systems were getting computerized, the systems were getting installed, ERPs were coming in. And from 2015 onwards, now if we think we are all very different. The accounting is done by the systems. We are getting tools to manage our taxes, cash flow. My systems can actually give me my estimated cash flow calculated for 1 week, 15 days, 1 month, 2 months, 3 months. So I don't have to really do any calculation, but my system does it for me. And then what is the role left for me to be the strategist, to be the real business partner for my business units, where actually the CFO contributes to their achievements in terms of what we are doing. If we think about, and let me just say it a little bit with a humor, if you remember the dialogue from the movie Diwar, where it says, "Mere paas maa hai," if you remember that dialogue, the accounting gatekeeper, as Priya just mentioned, was, "Mere paas company ka checkbook hai," So from those days till now there are no checkbooks issued, there are no checkbooks used. The cashier is not there. We don't have any cash transaction in our books. So the way the role has evolved over a period of time has come from the fact that the CFO function has become more and more a navigator of business. We are actually navigating the business to support the management of the company to see that they don't lose their track. They don't divert from the path which has been decided. And if they're diverting, how can we quickly really adjust our systems and our support to the team so that we are back on track? So that has become the main role of CFO. And now we are adding, as you rightly mentioned, the ESG function, the M&A, the effect of the international businesses. This is what is coming into foray, where we have to really work continuously to look into our numbers and so guide the business accordingly.
So just to support what you just said with we are a data analytics firm done in Bradstreet. So, there is always some bit of data which is buzzing in my head. So as per a recent study, there are about 35% of CFOs today are co-sharing the leadership or the strategic leadership along with the CEO. And a whopping 79% of the CFOs are focusing and investing on digital transformation for the organization. Another very, very key data point is about 66% of the CFOs surveyed said that they are going to invest in new business areas despite all of the uncertainties that exist in today's market, right? So if this is the context and if this is the scenario in which today's CFO is living, a question and also a request for some of the best practices is how do CFOs do it and how you do it in your life? How a CFO can align the finance function and your financial responsibilities to the strategic business goals of the organization. How do you do that, sir? Maybe I can come to you.
Yeah, so I work for a bank, so my context will be, how it operates in a bank. And obviously, Mayur or Jain may talk about, how it works in a manufacturing company. So in a bank, apart from what Pinky mentioned, the traditional function continues to be important. It's not that it's not important, whether it is, accounting or, statutory reporting, tax, those functions continue. But over a period of time, the function of finance is really enlarged. So if you look at, for example, the finance function which I manage, I have, apart from the traditional role, I also have business finance, corporate treasury, and M&A as a part of my function. So the key function, the key job of a team which is managing the business finance is working with each of the businesses to explain them the numbers and explain the drivers as well as what the levers are. This actually helps, the business to grow in the right segment. We also are able to give identify what are the blind spots. So for example, if there are certain products, so when we ensure that we give the transparency to the business, we are also able to give them clarity in terms of which are the products which are doing exceedingly well, at the same time which are not doing well. The job of this function is primarily to provide, a constructive challenge to the business, so that at the end it provide, the outcome is something which is the best for the organization. So that's the job which the business finance functions. The corporate treasury, which I just mentioned, has, two different, silos. One looks at the balance sheet management and the second is the capital management. The balance sheet management actually looks at, what incentive, disincentive needs to be done to be given to the businesses so that, the right assets or liabilities are grown. That part is something which helps the business to understand, what for the bank, what is the best outcome, from that perspective. The capital unit looks at what the ROE is for different products, different businesses, and therefore at the bank level, how do you optimize the capital? M&A is obviously for if there are any specific M&A opportunities which are available, which can actually complement your existing business or supplement your existing business. If you are already doing something, for example, within the bank, we do have a lot of partnership which we have with our ecosystems, fintechs, etc., which helps us, augment our overall sales acquisition, etc. So it plays a very, very important role from that perspective. So net, as I said, each of, with the change in the business, the role of the finance has also evolved, and we have now enlarged our own function such that we are aligned completely to the business and we are able to give them the right direction so that at the end, the outcome is the best for the organization.
Thank you. And let me come to you, Jayesh, for your inputs on the same.
If you look at the traditional approach we had numbers, and those numbers were to be presented. Now it's very different. We have to present the numbers with a different strategy. Okay. So one tweak, and I can't give you the numbers and what I actually did in my account in my college, but one tweak in one of the strategy ensured that my whole salary for every year is paid off. And that's what they look at. If I go to my CA days, the understanding the business was very important. You have to be in the midst of every time. And here, in this environment, in 2025, business dynamics change. Trump orders something one day, suddenly you have in India, Pakistan, you decide what to do, whether we should do trade, not trade, okay? So it's very different. So here, where we end up, and I was at college, so where we do this, we have an executive MBA and we try to engage those students into cross-functional approaches. And we have a mixed batch of people. So engaging and valuing each other's discipline is very important. For me, finance is important, but for me, marketing is not really important. For technology, no. But you have to be in the understanding of it. Because when the organization works, it doesn't work on one channel. It works on all the parameters. So you have to understand how marketing works and how will you generate those additional sales for us without affecting the brand. The brand is very important in today's DNA. Okay. And that's how we work on it.
Well, very, very nicely put. And that brings us to the second section of this panel discussion. So while the role has evolved and there are many hats that the CFO is wearing, there is another aspect of CFO's day-to-day life, which is scenario planning and risk management, right? And it becomes very, very critical because you are the co-leader of the organization. You shape the future. And I depend, being a business leader, I depend a lot on my CFO. I always take his advice whenever I am taking a decision because he gives me a prudent advice. Mukesh, this is okay. This probably could be very risky. So how, and let me come to you, Pinky, with this question. What role does scenario planning play in protecting business during uncertain times, such as one that we are living in right now?
Yeah, okay, it's a good question. See, right now, from last 4-5 years, the world has been really turbulent. Look at the pandemic. The first is started. Second is a global recessions. Then the European countries. Where the second thing is right now is a geopolitical tensions, Russia-Ukraine war, the tariffs which the US is speaking about. So it has become very volatile, to be very frank. So scenario building really plays an important role. Let me give you a live example. When the pandemic came, my all budgets for the next year were freezed in the month of February. Okay. And I think this pandemic started in the March end, April beginning, it started. We knew that now demand is not going to be there. Consumer demand is going to be less for all my these things. Then what is a way, if the top line is not growing, how I can control my bottom line, at least I can save. The first thing was that how I sit on cash, because cash is supposed to be the king at that point in time, that I have a sufficient liquidity. I looked at each and every item. Again, I sat on the table, looked at each and every item of the cost. I started renegotiations. I have totally 1,600 branches because I have a life insurance, health insurance, NBFC, housing business, AMC, mutual fund business. So total 1,900 branches. I started renegotiating the rent, which is supposed to be the main cost for me apart from the salary cost. That how I can have a saving in the rent, because my branches were not supposed to be working at who is going to visit the branches, At that point in time, even surrendering instead of let's have a win-win situations with the landlord, I could save. So each and every item is where I can save the penny. Even the capex and the investments were curtailed, because there's no point in investing when you're really not aware of what is going to be the future, how the pandemic is going to last, and all these things. So the thing is that the scenario building really helps in, coming out with what are the various options which are available to the management and take the timely decisions. The second thing in case of a global recessions. So you are aware that which are the countries where in case of a manufacturing where you are, exporting, if it's not going, whether it is possible, to shift your sales to another or to curtail your sales and save the fixed cost and the operating cost. Secondly, how the commodity prices are going to move. Sometimes in geopolitical tensions, you may get the export ban, you may get the sanctions. You're not going to deal with so-and-so countries and all these things. So I think scenario building helps, to take a very realistic, the dynamic view. I think presenting all this to the management or the board members, they are also, what I said that they are satisfied that whatever the decisions what we are taking has been taken, after taking into consideration all the factors. So no longer this scenario building is supposed to be a theoretical exercise. It needs to be done, you need to tweak your model. Your model has to be agile. and is the role of the CFO to make it more business resilient. That's the thing.
Great. Thank you so much for that answer. And may I come to you, Mayur, to add with your inputs in terms of role of scenario planning?
Yeah, sure. I think uncertainty in the business is always there. Right? There is always problems, whether we call it, let's say, from the time 100 years back when the World War I started till World War II or the Great Recession of 1930 or the political changes just Pinky has just mentioned. We as a business unit have to be prepared for the uncertain future and uncertain events in all the times. What is changed now is the reaction time is very less. We have to be very, very prepared in terms of resource management to be really response to the uncertainty in much faster way. And what is happening today is that I think COVID example is fresh. I think as one of the example, and now as you mentioned about the Trump effect on the business, the tariff effects, and then Russia-Ukraine war, as you mentioned. I think we have to be all prepared. I'm in the logistic industry, supply chain, freight forwarding. When the Suez Canal issue came up couple of years back or 2 years back, we have to be really innovative and prepared to adjust to the uncertain situation. And what I believe is that in our trade, at least, I as a CFO and my team, we do repeated rolling forecast exercise, which is very important for us as a tool. And every month we do with the business unit a very objective and transparent rolling forecast, where actually we envisage what are the changes happening in the business and how can we adjust the forecast. So it is completely different than the budget. It is very straightforward. You put your business forecast as per today's situation and then review it. And then what secondly we do is that we also align with the medium-term planning in an effective manner, because that also as a CFO our role to really guide the business in terms of what resources we can allocate to certain level. And as Pinky mentioned, various scenarios, different strategy. But we have to be mentally prepared, not really put it in action, but prepared that if something like this happens, how we'll react to it. And very important for in our trade, what we did is that we have built some long-term partner relationship with suppliers, because in supply chain situations where we are today, our relationship with partners who are our suppliers, and like Pinky mentioned, like for example, if she has to maintain 1900 rental contracts, this is all the suppliers what with we work. Relationship with suppliers has become very, very critical in this time of uncertainty. In whatever way we deal, whether it's a bank, for example, with a service provider to us, support, financial support, or all kind of service provider. So I think uncertainty management has gone to a level where we have to be prepared. The response time is very less, and we have to be ready with the solution always.
Great. And if I may ask your inputs as well, Rajesh.
Yeah, so we all are living in a VUCA world, and therefore the only certainty is the uncertainty. And we really need to embrace this these type of shocks. Now the disruption can either happen because of an event, which means either something happening in America which is impacting us, or it may happen because of competition. Suddenly there is a change in the business model. From our perspective, when you look at the scenario planning, if you look at in the past, scenario planning was prevalent only in military. But over a period of time, you see that even in corporate it has become really essential. If you look at the 9/11 incidents, or for a bank, the Lehman incidents, or even for COVID, when COVID happened, for many of the industry, overnight the entire revenue disappeared. Now these are you may say that are very theoretical if you would have done this exercise maybe 10 years back, but in reality it has happened. So the point which is important is when you really look at scenario planning, it is basically looking at what are the it's an iterative process where you think about what may happen in the future and then plan in the present. And when you are really doing that, it really reduces the element of surprise when those events happen. It helps you in terms of, sensing it, scoping it, as well as adopting to the change. Now, how do you really look at, how do you do scenario planning? The scenario planning is nothing but looking at, what are the type of various events which may happen, and then look at, those which are most probable for your type of industry, and then working on a desktop exercise. This really requires, significant amount of time and energy to be invested. It needs to be top down. The second thing which is also very, very important here is that scenario planning is not a one-off exercise. It's something which need to be done, on an annual basis. And the third thing is you need to ensure that, when you are hiring any senior or middle management level, you see whether those people have experience in handling those disruption. Because when you have the whole team, which have handled this disruption, at some point in time, it adds to the value when you really have those type of disruption. The other point which also is important is when you look at, scenario building, it's not that you can plan, everything, you will be able to plan everything which may happen in the future. But when you have this rigor of doing this exercise on an annual basis, it helps you in terms of building the agility as well as nimbleness, which is really required when there is a change in the event. So it really prepares you in that direction.
And that brings me to the another aspect of CFO's day-to-day work. I mean, more and more CFOs are chief risk officers as well, or responsible for risk management in their organization. And proactive risk management is another thing which is very, very important beyond scenario planning. Many people today are investing more and more on cybersecurity risks, and therefore cybersecurity incidents have gone down by almost 50%. There are people who are, managing and investing into proactive risk management tools, data analytics. So my question now, and I would like to come to you, Jayesh, with that first, is how can CFOs lead proactive risk management beyond traditional financial controls?
This concept of risk is very dependent on luck. Okay, if for us, what happened in 2016-17 is we tried a model which was hybrid. So we had till 2015-16, we had in-house classes. We never went with a hybrid model. But looking at the industry, we moved from a traditional model in classroom to an offline hybrid model where we had in classrooms as well as online. And that really helped us in COVID, okay? In terms of, and also in COVID, in terms of investments, yes, the bankers were very helpful to us because at times you don't expect liquidity will come and students might not be able to pay. Okay, in terms of COVID, students will not be able to pay. So how do you handle that? The bankers really helped us in that regard to boost our cash flow or to hold on to the loans we had and stuff. That really helped us in moving forward. And then it was the country India who was being challenged. Okay, so we worked with all the vendors and we said, okay, something which you can let go without hampering your business, okay? And that's where we did. So now the relationship with the vendors are that we want to work with you. You don't give us increments, fine, okay? But that's the relationship we created. We created a relationship with our vendors as well, so that, and with the bankers, definitely they were our vendors, but they really helped us, but we reciprocated that with the other vendors as well. And that's where we build a structure where everybody coexisted for us. So it was not us who was benefiting or was getting affected by COVID, everyone else was. And how each of us can actually give up something to have overall good and help country India to take the
Well,
step
thank you
forward.
so much for sharing that perspective. Let's go to Mayur very quickly on the same question because you represent your industry. What does actually proactive risk management or what demands proactive risk management in your industry, and what is that you do which is specific to your company or industry on proactive risk management?
I think for us in logistics, the customer risk is our risk. In many contracts, the logistics service providers are being made responsible to take care of the customers' cargo goods. And what we do is that proactively, of course, to take insurance. Right? So that's the basic thing which everybody does. But I believe that what is happening as a change in the industry that earlier people were trying to hide things from whenever it happens. But now people are more open because they know that hiding is not going to work. Actually, it is much more dangerous, risky to hide things. So, in a simple terminology, and I'll give you an example to this. About 1.5 months back, for one of our customer, not to be named, 6 containers fell into the sea from the vessel. Okay. Now, of course, everybody is trying to say, okay, not my fault. You know, it's a act of God. You know, whatever you want to call it under insurance. But actually, in this case, we have protected our customer through a complete chain of incident in terms of the proactive risk support, not only to support from the documentation perspective, but also to ensure that they get all the support to get the insurance claim and also manage the subject cover from their side. However, from the finance perspective, I believe that the risk management for our kind of business is to ensure that the business continuity is maintained. So I think it's more of a, something which is covered by insurance, but business continuity is seldom protected by insurance. So as a CFO, our team actually continuously participate in the BCP programs of the company. And whenever certain things happen, like 2 days of rain, couple of us have problems in Mumbai. In our warehouses in Bhiwandi, you see what kind of problems is happening with the rain. A BCP is very, very helpful tool for the CFO world to be part of as a proactive risk management. Whenever and whichever company we work on, I think a business continuity plan has to be very well structured in all the organizations.
Awesome. A logistics CFO telling customers from risk point of view, jo tera hai, wo mera hai, risk, right? Awesome. Very nicely put. And that brings us to the last section of today's panel, and which is very, very important, strategically important and very critical. And that's about capital allocation and investment strategy. Now, well, there is no one single answer to that. Everyone has to take decisions according to the industry that they are, according to the company that they are working for. Still, there is a pretty strong question in terms of capital allocation. What are the key principles for optimizing capital allocation in a competitive landscape, right? So maybe I could come to you, Rajesh, to begin with in a banking industry. What are the key principles that you follow for optimizing capital allocation in a competitive landscape?
Yeah, so in a bank, unfortunately, your ability to growth is directly dependent on the capital. And obviously, there is always, more demand for capital than how much you can supply. So for us, at least for me, what is most important is, really looking at, what the business case is. And whenever there is any business case which comes to me, I have to, what I do generally is, I first look at, what the underlying assumptions are and how robust are those assumptions. Those assumptions are stress tested to see, what are the pro and cons. So at the end, you know that, if the assumption does not stack up, just like what we mentioned, scenario planning. If the assumption doesn't stack up, what is the quantum of risk which you are running on your balance sheet? That becomes a clear path. The other path which also is important is that, when you look at the capital allocation, particularly for new projects, etc., it's very, very important for you to also define what the stop loss is there at the inception. Because if you don't have that very clearly defined, you then go into what is called as, sunk cost fallacy. अरे इतना पैसा डाला है और थोड़ा डालूंगा तो हो जाएगा, and then you end up having a cycle which never ends. So it's very, very important for you to look at what what is your stop loss, and ensure that that is clearly defined and everyone has agreed, on those matrices. The other part is once, you allocated the capital and you have certain projects which are ongoing, it's also very important to ensure that, you have dashboards in place so that the progress of those initiative, etc., is measured on an ongoing basis. And that will actually give you a very clear RAC status, whether it is red, amber or green, in terms of, how the project is running and is there any risk which is there. And if there is any risk, you can take a course correction rather than waiting till the end. So you need to have a very strong lead indicators, in your process, which can help you, give clear identification in terms of, where the project stands, and you don't have to really wait for the end, where, timelines are not met or your objectives are not met. So that's the way in which we generally operate.
Thank you. Mayur, would you like to add to that?
I think different from different industries. I think as banking, what you mentioned is very different in terms of manufacturing, supply chain businesses. I think in the world where we are in the logistic industry, and I would say in general for everyone, I think capital allocation is the key resource management which we do as a business to support the business. And I always seen that there is initially a huge demand from all the business unit in terms of I need more, I need more, I need more. That's how is the general approach from the business. It's our job to see that we really make a right decision in terms of how much capital we allocate to various units, various businesses. If you want to open a new warehouse or if you want to open a new branch, for example in a bank or to take a new office, it is up to us to make a wise decision in terms of how to allocate capital. But what has helped in terms of the business decision making is that in terms of keeping a bit flexible approach to the capital allocation has always helped. So when you are investing into infrastructural things, you are very less flexible. You have to say that I think almost 60% of the investment goes into infrastructure area, and then remaining 40% is your play area where you can actually time your capital allocation with the competitive market. I think when we invest, competitive forces are always kept in the mind, but ultimately when we come to a decision-making phase, and that time if there is a need to change the decision or be flexible, that's where the CFO comes into picture to say, okay, can I deviate from this path to a little bit on this path and say that we take advantage of a higher return on investment in some area as compared to where we have planned. So I think a split of investment, split of capital allocation in some certain segment as a flexible and fixed help us to really manage it well in the time of changes happening.
Well, thank you so much, Mayur, for that answer. And that brings me to the last question to the panel. And it's very critical because the world is changing very, very frequently. Every day innovation is happening. The speed to innovate is very fast. And that's why businesses have to continuously keep up with the change. And in that kind of a scenario, investing in innovation is not a favor that you do to the organization, right? It's an imperative. If you don't do it, your organization is going to fall behind. So the key question in that context is, how can CFOs craft investment strategies that balance innovation with financial prudence, right? Of course, people like me will always keep coming asking for money for this and that, but how do you balance that, right? And may I come to you, Pinky, with this question first?
Yeah. So the thing is that initially any investments, we want to look at the, traditional way of, making decision on any of the investment will be the hurdle rate or a payback period. But these are the metrics which are there, but no longer holds good. We need to, tweak in our model of, making more dynamic and take into account. Otherwise, we are missing the big picture of, that the the growth in the sense of the digital transformations or a speed to a market or a customer long the LTV, and the thing is that the market responsiveness and all these things. So these are also the metrics which needs to be taken into account when make an investment in any of the innovations and all. And apart from the traditional these things, I think the today modern CFO also needs to take a bet on keeping aside some of the portions on such kind of an experiments. This can be done by not investing everything but doing it a stage wise milestone, and having a good the governance framework to look at that what kind of progress is been able to achieve. The second thing is that keep aside some portion of your investment into such kind of an innovations strategy. The third thing is that let's form a the group of the cross functional people, bit it is from IT operations and all these things to look after. Otherwise just looking only at the in manufacturing we used to see the EBITDA and the ROC. Here we look at the return on equity, the ROI, and all these things are there, but that no longer holds the good. No? Otherwise, you are missing the big picture. And traditionally, what I always said that no longer we are the only guardian of the capital, but we are also the co-creator of the enterprise. The value to create the shareholders' value. So we need to tweak our model, make it more agile, make it more dynamic to take these metrics also at the time when we make such kind of innovation, the investments.
Thank you so much. And let me come to you, Rajesh. How do you craft strategies that balance innovation with financial prudence?
So when I jokingly tell my team that, when I started my career, one of my earliest boss told me that, when you look at the business proposal, please be, please take this into note. Expense is a certainty, revenue is a hope. The reason why he said that is because when you look at the business proposal or any investment, it will always be, very, very rosy. So, the key role which finance really plays is to look at, what are the assumptions which have gone behind those investment, and look at bringing, and you need to try to bring, either, whatever information may be available within the bank in terms of, the product, those assumptions, whether you have the data point, or bring in outside in view to say that, how robust are those assumptions. And you need to ensure that each of these are stress tested, very, very clearly. And as I said before, you need to ensure that, there is a very clear, milestone wise, particularly for long investments which are required, you have clear milestone wise, objectives which are there, which are clearly measured, on an ongoing basis through, dashboards, etc., etc. And as I said, for each of these investment, you need to be very, very clear about, what the stop loss is, so that, at every point in time, you're clear that, is it going in the right path, or is there something where you need to do this thing? Because as I said, otherwise you will go into this sunk cost fallacy in terms of, keeping in investing, and, before you realize, you already burnt significant amount of capital on something which probably may not be able to earn this thing. So it's something which you need to do as a process, and obviously, some of these things need to be monitored on an ongoing basis.
Thank you so much, Rajesh. I hope my CFO was not listening to that phrase. Otherwise, I'm going to listen that again and again. But wonderfully put, very nicely put. I will come to you, Jayesh, with your inputs on the same. How do you craft your investment strategies?
The fundamentals of any accounting role, be it accuracy, compliance, governance, is very important. But today's DNA is a little more different than the generation we are from. They want to chip and change very, very fast, which we have to be a little safeguarding their interest as well as looking back. So if you're looking at doing any investments in any of these sectors, what's the value? He mentioned, Rajesh bhai mentioned about sunk cost, okay? Whether a program which we are continuing with, is it still in the COVID era or later, is it giving me that additional revenues? Or when I look at cost accounting, I look at variable cost. Okay, if I continue with the program, what's my variable cost? What's my revenues? And that revenue, is it not about revenues? It's about, we have executive courses. So we have lots of corporates coming in. So building relationship with those corporates help us in a long way in terms of getting placements also. So that is the investment we do. Okay, it's not about making profit on a program. It's about valuing those relationships and taking them forward. And that's where it really helps us on an ongoing basis.
So you keep the long-term customer value in mind.
Very, very important. Very, very
Of
important.
course, very nicely put. And that, ladies and gentlemen, brings us almost to the end of this panel discussion. We still have a few minutes at our hand. So if you all are okay, I would like to invite a couple of questions from the audience. If today I'm fortunate to have this esteemed panel. So if any of you have any questions to dip into the experience from the panelists, please do ask questions. Of course.
Hello.
Can someone? Yeah, of course. Please introduce yourself, sir, and then ask your question.
Hi, my name is Ritesh Gohil. I'm part of investment banking team at Incred Capital. For last 15 years, been advising companies for raising funds, mergers and acquisition, cross-border domestic, and of course, private equity funding across various sectors. That's about me. My question was, I was listening to the panelists, but as a CFO, what keeps you awake in the night? What are those North Star metrics which sort of creates goosebumps or jitters at the night? Because as a CFO, I understand capital is critical, allocation has process. But having said that, done that, what keeps you awake? What would be that one thing which would always buzz in your mind?
So for me, I'm coming from a manufacturing background which was totally unregulated to a regulated entity. You really don't know that what kind of regulations are going to come, because again, any regulations come, we need to again look at our business model, to relook at it, and really changes my full, the profitability and all, to be very frank. The other thing, sitting on the large data of the customers and all this, I really get scared of the cyber risk and all this. Is a big risk which we are having. Plus, I am having a multiple business, so I had to be very careful at regards to the data privacy and all these things. So this really makes me, and the thing is that being regulated, I have to be more and more compliant, have a governance and the compliance of the highest order. That is really scary for me if anything falls off through. That's
Very truthfully expressed. Thank you so much for that. And maybe we can take one more question from the audience. There was a gentleman sitting there. Yeah, can you get the mic to him, please?
Yeah, hi, my name's Rajesh. I'm representing Konica Minolta India. We're in the business of production, printing, office, and security systems for India. Globally, Konica Minolta is also into medical diagnostics. I observed something very unique when I saw Mayur, speak about his customer and what kind of partners, what he expects from his partners. And then I heard Rajesh and I heard Pinky ma'am talk. So when I see the three of y'all, okay, excuse me, Jayesh, for not including you, but movement is key to Mayur's business, probably managing to Rajesh's business and sustaining to, Pinky's business. But when you think about somebody who's going to partner you, your vendor partner, what are the couple of things or 2-3 things that you see in somebody who's going to support your organization as a whole? What are the 2-3 things that you see in your partner who's going to support you?
Okay, I think I'll take about at least one or two things in terms of what we look into the partnership. And in being in the service industry, to align with the partner's relationship is very critical. And I believe that when we work with the partners, we always see as to, in terms of the strength, what they add in terms of the partnership and the business extension. So I think when we look at the partner and when we evaluate them, of course, compliance and other norms are always the part of the game. But when we look at them, we always see that whether they will withstand the pressure when it comes on the business for us. And that's how we align with the decisions, whether somebody can really reciprocate to our needs of business when the pressure comes in. And that's the one very important factor which we take into consideration.
I work for a bank, and therefore, we have, heavily regulated by RBI. So from my perspective, when we look at any partnership, the first and foremost is, the reputation of the partner, which is, because at the end, every transaction which you do, it is your reputation at stake. And therefore, from that perspective, that is something which is non-negotiable. Once that hurdle is cleared, the second part, which is again very very important, is it an equal partnership or is it going to be one-sided? Obviously, if it is going to be one-sided, either on their side or our side, the objectives are never going to be aligned, and therefore it's very very important to see what is in for us, at the same time what is in for them. Why are they interested in this, and how do we ensure that our progress, our entire partnership can grow. And that needs to be very, very mutual. And there need to be a significant amount of trust between the partner. Otherwise, everything which you do will get questioned, and you'll end up spending enormous amount of time in these resolution, which can be counterproductive. So you need to ensure that all these things are looked at at the inception, and once those those hurdles are cleared, then you look at something which is more commercial.
Of course.
No, nothing.
Well, very nicely put. We need to choose our friends very, very wisely, right? Because we are choosing them. It's not relatives that have come. So very nicely put. And that, ladies and gentlemen, brings us to the end of this panel discussion.